Hi everybody, in this video we are going to cover financial statements and accounting information, so specifically chapters 3 and 4. We are going to go over key financial statements like balance sheet, income statement, and statement of cash flows, and then we are going to talk about free cash flow, which is going to be important later in the course when we evaluate specifically pricing of stocks. And we are also going to talk about federal tax system in chapter 3. And then we are going to talk about chapter 4 in detail. So let's start with basically the annual report, which contains key information such as balance sheet, income statement, statement of cash flows, and statement of stockholders' equity. The book is written for accounting majors as well as finance majors. So from book's perspective, it's also written for non-accounting majors. And since this video is specifically designed for accounting majors, we are going to go through chapters 3 and 4 rather a bit faster than usual. In the book, we are given the Leon's Inc. As an example. It's a snack food company that went under major expansion in 2014, and the results have been unsatisfactory, and board of directors who are responsible for shareholders' value has ordered that changes must be made. And the book analyzes the balance sheet of the company between 2015 and 2014, and we look at the balance sheet of assets as well as liabilities and equity. And then the book compares the income statements between 2015 and 2014. You can go over the details from the PowerPoint slides that I'm uploading to e-learning. But what you are going to see is net income has decreased from 2014 to 2015. Number of shares has been the same. Earnings per share is negative in 2015, so there is a big difference between 2014 and 2015. As a result, dividends per share has decreased. The stock price plummeted in the sense that it's almost 70 to 75% decrease from $8.5 to $2.25. And when we look at the lease payments have been pretty much standard as they should be. We look at the statement of stockholders' equity, and we see that the retained earnings, since there is net income is negative, and on top of that you are paying cash dividends, decreased significantly from the previous year. Since net income is negative, as a result, when we look at operating activities, the cash flow from operating activities, the main driver of cash provided by operating activities, which is negative, which that means there's a decrease from operating activities in cash. It's mainly driven by, again, net income. Investing activities has been negative as well, and financing is basically what it's doing is it is compensating for the investment activities as well as operating activities. They did it by issuing long-term debt, notes payable, and pretty much provided financing through that. As a result, there is still the financing activities couldn't compensate for all. So as a result, there's a net decrease in cash, around $50,000 from $57,000 to $7,000. As I mentioned, the negative cash flow from operations is mainly due to negative net income. Firm borrowed an additional $836,000 to meet the cash requirements from operations and investment. And even after borrowing, the cash fell short by $50,000. The question is, did the expansion create additional after-tax operating income? And the operating income at the beginning was minus 130,000. There is a tax shield for income. So the net operating income after taxes turns out to be negative $78,000. The net operating income, if you want to compare that to after-tax operating income from 2014, was $114,000. So what we are seeing is, there is a significant decrease in after-tax operating income. Net operating working capital was $842,000 in 2014, and that increased due to expansion mainly to $913,000. Yes, when we see expansion, yes, the sales increased from 3 million to 6 million, but after-tax operating income significantly decreased. It was a positive, now it changed to a loss. And net working capital, there is an increase. Net income as a result has changed from positive to negative as well. Now, the net free cash flow turns out to be for 2015 a negative $744,201. Negative cash flow is not always a bad sign, but in this particular case we are going to see that it's a bad sign because mainly it is done through net income, and the negative effect of net income is reflected in free cash flow. If you look at the performance measures for evaluating managers, what we need to look at is the market value or market value add, the difference between the market value and the book value of the firm's common equity. An economic value add, that is the estimate of business's true economic profit for a given year. The economic value add simply is the after-tax earnings including interest. So what we are taking is earnings before interest and taxes and multiplying it by 1 minus tax rate, and then we are subtracting basically what's called the opportunity cost, the cost of capital in percentage terms multiplied by the total invested capital, and that determines the total economic value add for this business. Now, the market value add was basically a negative in 2015, and in 2014 it was positive. And what we are doing is we are looking at the market value of the company and subtracting the book value of the company. And as we see in this example, a sign changing from positive to negative indicates that the shareholder wealth has been destroyed. What we are going to see is the economic value add is positive. When the economic value add is positive, then after-tax operating income is greater than the cost of capital needed to produce that income. And positive economic value add helps to ensure that the market value add is positive as well. Now, the company cannot pay its suppliers on time either, just because when we analyze accounts payable, it increased by 2.6-fold, so 260% over the past year, and sales increased only by 76%. And if the trend continues, then the firm is really in trouble. Suppliers may cut off the trade credit. The sales price does not exceed the cost per unit sold, and the reason for that is negative after-tax operating income. It is a negative, and there is a declining cash position, so it's spending more on its operations than it's taking in. The one idea that's thrown out there is to make the situation a bit better, or does it make it better if the managers decide to offer 60-day credit rather than 30-day? What's going to happen is if they do that to match competitors, the accounts receivable would increase and cash would decrease even further. The one question that has been asked is, how did Leon finance its expansion? It's financed its expansion, as we've seen, through cash flow, statement of cash flow. They finance it with external capital, specifically through debt. There are other questions that is being asked throughout the presentation. What if you change some accounting practices? What if you change depreciating asset over 7 years as opposed to 10 years? There is no effect obvious on physical assets. The net income would decline just because you are accelerating the depreciation and hence taking a larger depreciation charge. Tax payments would decline as a result, and cash position would improve from that standpoint. So there is, one side where the net income would decline, but at the same time the cash position would improve just because you would be paying less taxes. Now, speaking of taxes, there are two types. As I mentioned in the previous video, there are individual taxes and there are corporate taxes. When there is a corporation and when you are getting dividends, the corporation gets taxed first, and then the individuals get taxed on the dividends that they are getting as well. And the taxation has on both corporate and personal have a progressive structure. What that means is the higher the income, the higher the marginal tax rate. So for given specific income rates, there are specific tax brackets. And the last three slides of the presentation briefly talks about the tax treatment of various uses and sources of funds. What I want you to take away from Chapter 3 mainly is the key concepts such as economic value add, where you take a specific accounting income and then subtract the opportunity cost from the operating income, which is cost of capital multiplied by the investment amount, and you calculate the true economic value add, and that determines how you are going to evaluate a specific management. Now, with that said, let's talk about Chapter 4. In Chapter 4, we are going to analyze the financial statements that we covered. Specifically, we are going to look at the ratio analysis, and then we are going to look at the DuPont equation. We are going to continue covering the same example that we had in Chapter 3, and we are going to see the effects on improving the ratios, and finally we are going to talk about the limitations of ratio analysis and talk about the qualitative factors. Now, if you look at Chapter 3 again, we have cash, accounts receivable, and total assets. We are given the balance sheet assets. We have the liabilities. We have the income statement, 2015 to 2016 as an estimate. And 2016 as an estimate is also given. Number of shares, earnings per share is estimated to increase, and dividends per share is going back to 22 cents per share. Now, before we go into the ratios themselves specifically, I want to show you why the ratios are kind of useful, because they standardize the numbers. The numbers themselves, whether $1 billion is significant or not, depends on the overall operations of the business. If it says a relatively smaller business that is public, obviously it's important, but for larger companies such as Apple and Google, those numbers are relatively smaller. So we are trying to understand how we standardize these numbers, and we can facilitate the comparisons. We can facilitate the comparisons through different companies where they have different incomes or balance sheets figures. We can also compare the same company over the years using the standard ratios. So we can do industry analysis, benchmark analysis, and if we compare it through the years, we can do the trend analysis. There are 5 main categories of use of ratios. One is the liquidity. The ratios in this bucket evaluate whether the company can make the required payments on time. Asset management specifically is whether the right amount of assets is applied, whether the sales asset turnover is the good example for that, whether they can generate the right amount of assets with given sales. There's debt management ratios, which looked at basically the long-term debt, whether there is a right mix of debt and equity. Profitability ratios, return on equity, return on assets, profit margin, and then there is market value assets such as price to earnings ratio, market to book value ratios, and so on. Now, going back to our example from chapter 3, let's take a look at forecasted quick ratio and current ratio. And these are liquidity ratios. We are starting with the first bucket where we calculate the current ratio, which is current assets divided by current liabilities. Quick ratio is the current assets less inventories divided by current liabilities. If we analyze these, and we are going to see that that the company dipped in 2015, and then it is bouncing back to 2.34, and it's kind of improving the results, getting in line with 2014. But the industry average is 2.7. It's well below the industry average. So we can conclude that the trend analysis says us, okay, it's improving, but if you compare it to industry, there's still room for improvement. It's still below the industry average, and hence liquidity position for that industry, for that company, is weak given the industry. Inventory turnover ratios, which is sales over inventories, is 4 times, and the industry is 4.6. Industry turnover is below the industry average. The company might have an old inventory, or its control over inventory may be poor, and there is no improvement that is currently being forecasted. So we look at the results, and the sales over inventories is kind of decreasing, which means the inventories are increasing, or the sales is decreasing given specific inventories. Days of sales outstanding, which is receivables divided by average sales per day, receivables divided by annual sales divided by 365, is 45.55. Now, if you look at it from 2014 on, it's steadily increasing. So it's getting worse in the sense that it takes more and more time to collect the outstanding debt. And hence, what we are concluding here is the company has a poor credit policy. If we compare it to trend analysis, or if we compare the latest estimated results to industry average, from both perspectives, it is a poor credit policy. Then we look at the fixed asset and total asset turnover ratios to compare basically the operations and the efficiency of operations. Fixed asset turnover is 8.6. Total asset turnover is almost 2.01. And what does those mean? We need to look at them in context, specifically by looking at the trend analysis. It decreased in 2015 significantly, and it's kind of increasing. So And we are seeing that there's a total asset turnover ratio is steadily decreasing, and it's below the industry average. So from fixed asset turnover ratio, it's projected to exceed the industry average. That is good, but the total turnover is below industry average, and it is mainly caused by excessive current assets, specifically as we see from DSO. The account receivables is increasing, and if we look at the inventory turnover ratios where inventory was increasing, and hence the combination of accounts receivable and inventory causes the total assets turnover ratio to decline. Then we look at the solvency ratios, or debt to capital and time interest ratios. Debt to capital ratio is total debt divided by total invested capital, and times interest earned ratio is earnings before interest and taxes divided by the interest payments. If you look at it from a historical perspective, we are going to see that debt over total kind of jumped in 2015 as a result of heavy borrowing, but it's getting better in 2016. The company's estimated debt to total invested capital seems to be well below average. And finally, we look at the profitability ratios. We look at the operating margin, profit margin, and basic earning power, which is the earnings before income, interest and taxes divided by total assets. If you look at operating margin, we are going to see that the company had a very bad year in 2015, getting better in 2016, but still below the industry average. From profit margin perspective, it got really worse. We know that in 2015, and in 2016 it's getting on track and slightly above the industry average. And basic earning power is basically improving. That we are seeing that, but it's still below the average, just because the assets, specifically the accounts receivable and inventory, turn out to be greater. So we are seeing that the total assets as a result is increasing, and hence the ratio is decreasing. Overall, what we are going to say is that the company had a very bad year in 2015. It looks like they are getting on track in 2016, but there is still some room, specifically on certain ratios, to be improved. Finally, we are going to look at how the market is perceiving, or how the market is reacting to these types of changes. So we are looking at price to earnings ratio, and what we are seeing is the price to earnings ratio significantly dropped, and it's kind of negative because of negative earnings in 2015, but then it increased in 2016 estimated. It's still below the average, but the market is reacting it fairly positively. If we look at the market value divided by book value, the same story is there. We are seeing that the market is reacting in a positive way, but the company's market value divided by book value is still below the industry average. Now, what does price to earnings means, or market to book value? It's basically how much the investors are willing to pay for $1 of earnings, and it has different components in it. The future prospects, the future growth prospects, etc., play an important role, and that's one of the ways to measure the market's reaction to the company's earnings. The other one is market to book value, and that is how much the investors are willing to pay for $1 of book value. For each ratio, the higher the number, the better it is in terms of the companies. If the numbers are higher, then the market is perceiving them very well, So, and it means that the market is expecting higher growth and better management of the company. Now, with that said, let's turn our attention to what is called the DuPont equation, which is decomposing return on equity into different parts. If you look at return on equity, and if you say it is basically net income divided by sales, multiply that by sales divided by total assets, and that becomes, sales will cancel each other, net income divided by total assets. Multiply that by total assets divided by equity. This time total assets will cancel each other, so it's net income divided by equity. The reason why we are looking at return on equity in this sense is because we want to look at how profit margin, how total assets turnover, and the equity multiplier, which is a function of the leverage, plays out in return on equity. If you look at the historical trend, we are going to see how the profit margin is behaving throughout the years. We are seeing how the total asset, ratio, asset turnover ratio is trending, and how the leverage is trending. So what we are seeing is, again, it's a summary of what we've discussed so far, which is the profit margin is more or less in line with the industry average. Operations is less efficient, 2.6 compared to 2, and the leverage is there, less leverage. We know that from our earlier analysis. As a result, return on equity turns out to be less than the industry average. Now, we can improve some of the ratios by changing the policies, our credit policies, or some of the accounting treatments. We can change not all, but some of the ratios and improve those ratios. An example is reducing the accounts receivable and days outstanding. That will increase the cash freed up from operations. So what we are getting is, by the time we reduce or tighten our credit criteria, we are going to have more cash at our disposal. And what we are going to see is we are decreasing accounts receivable on balance sheet. That will improve definitely the ratios related to assets, total assets, for example, asset turnover ratio. And you can, with the cash at hand, you can do different things. You can decrease the debt even further. Or you can repurchase stock, expand the business, again reduce the debt, or take a combination of these actions. Will likely improve the stock price, because all of these are kind of doing in favor of stock. Now, ratio analysis is very useful, and it's been pretty widely used in the industry, but we need to be aware of the potential problems and limitations of the financial ratio analysis, and that is, the industry averages is difficult for conglomerate firms that operate in many different divisions in many different industries. And some of the different operating and accounting practices can distort these types of comparisons. It is, even though we are analyzing it through the trend analysis through years, or when we compare it to the industry, sometimes ratios, it's kind of hard to tell whether the ratio is good or bad. Again, it's especially almost impossible to tell if the ratio is good or bad if the ratio is a standalone and you don't have a context where you are going to compare that ratio. Other limitations are average performance is not necessarily good. Sometimes the firms need to aim higher. In specific quarters, if it's done on a quarterly basis, seasonal factors can distort ratios. Accounting changes can be made to distort or to make the ratios look better. And finally, inflation has distorted firms' balance sheets, so analyses must be interpreted with specific judgment. We also need to consider qualitative factors when we evaluate companies' future financial performance, and that is how are the firm's revenues tied to key customers, product, and suppliers? How is the firm in a specific industry? What percentage of the firm's business is generated overseas? What is the competitive environment, the future prospects, the product quality, customer loyalty, etc. All those things need to be considered to make a decision, especially to make a buy and sell decision when the company is concerned. We are going to talk about more of these factors in other chapters, but for now, next week we are going to start with the quantitative analysis. We are going to do a deep dive in time value analysis first, and then we are going to apply it to the valuation of debt of bonds and valuation of stocks, and we are going to continue with qualitative factors.